Hello and welcome to Portfolio Matters. Weekly markets checklist week 178, and what a start to the new year it has been. But before we get going, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. What do we have this week, Keith?
Well, before we get going, a bit of housekeeping. So this year, we're intending to do bi-weekly episodes once every couple of weeks, and starting on the first Tuesday of the month. And starting on the first Monday of each month after non-farm payroll. So that is why we're recording today. But I have a few hiking and skiing trips coming up, so the next one will just have to fit in when I'm around. Okay, the news. So last Friday, non-farm payrolls came out, and it was unambiguously positive. New job creation beat expectations, and for once, the household survey also showed strong employment creation. We'll take you through the data. The global bond sell-off, which started late last year, accelerated with the UK particularly badly hit, and regular viewers will know that means I got killed. Oil prices rose after the Biden administration imposed further sanctions on Russian oil and gas companies. We'll show you the data. And Russian gas flows to Europe via Ukraine ended on the 31st of December, reducing EU gas inflows by 5%. European and UK gas prices are well up over the course of 2024, and that is not good for consumers and not good for inflation. Elsewhere, Donald Trump has basically reiterated that he will be imposing tariffs on US imports. He becomes the new president of the US in the 20th of January, in less than 2 weeks' time. And finally, he has been shooting off on social media and in speeches saying that the US should buy Greenland, buy the Panama Canal, integrate Canada into the US, and rename the Gulf of Mexico the Gulf of America. The next 4 years could prove to be unpredictable and volatile. Some charts relating to the news. Well, after a strong non-farm payrolls report on Friday, the market is now pricing in only a single rate cut in 2025, and the talk this morning is of no rate cuts at all in the coming year. Equity markets had a bad day on Friday, finally reacting to the rise in bond prices. The global bond bear market accelerated, and since September, there's been an extraordinary rise in UK gilt yields, which take them back to the highest levels seen since 1998, just after the Bank of England became independent. This is gas flows into the EU from Russia, and you'll see that despite the war, we are still importing Russian gas. Now, the Ukraine transit is now over, and so we are importing less in Russian gas, but it is still an important part of our energy mix. And not just gas via pipelines, but also LNG, 16 million tons in 2024. Now, Donald Trump issued this tweet, says, "No more tax on tips, it'll be made up with tariffs," and much more from countries that have taken advantage of the US for years. And given the rhetoric towards the UK from Elon Musk and people close to the Trump administration over the past few weeks, I strongly suspect that if he's going to impose tariffs, then the UK will be on that list. And he's after Greenland. Now, under the radar, the debt ceiling is back, and if nothing is done, the US will hit it on the 14th of January. So More negotiations are needed if the US is going to avoid default. And finally, last year, the world breached the 1.5% above pre-industrial temperatures barrier and rising. Happy New Year, everyone. Okay, and on to this week's economic data. So UK private sector clearly weakening. Surveys are showing reduced confidence, but that will be offset by increasing public spending over the coming year. We are forecasting stagflation, although we'll have to see how far the private sector weakens, and the rising gilt yields means that the government sector will also have to tighten its belt. All that points to weaker growth in the UK. The EU appears to be weakening once again. The US is just fine and may be strengthening. China seems to be stable and improving, actually. On to the UK, Richard.
Hey, Keith. So UK construction PMI down on expectations at 53.3, and UK retail sales year on year better than expected, up 3.1% for Christmas, for December.
But the thing is, if you include, because November was so poor, if you look at the Q4 as a whole, it was up only 0.4% year on year, and these were in nominal terms. So in real terms, retail sales fell.
UK consumer credit month on month falling and below expectations.
Yeah, and that looks like a trend to me.
I would agree. UK mortgage approvals fairly flat for the last few months.
And I fully expect these to start falling off, because we've had a huge rise in the UK 2 and 5 year interest rates, which is where mortgage borrowers are sensitive to. Those have risen by over 1% over the course of the last 3 months, and that makes housing just unaffordable.
Apparently, there's another 800,000 people will be coming off 5-year fixed rates this year as well.
Yes, we have the chart later, Richard.
UK mortgage lending in November was 2.5 billion, substantially below expectations, but not out of line really with the rest of 2024. And net lending to individuals was down in November, but again, not particularly out of line with the rest of 2024.
Yeah.
Okay, money supply and import actually been pretty flat now for the last 2 years.
Yeah.
Nationwide house prices up 0.7% in December, month on month. So house prices are actually beginning to creep up again at the moment. Year on year, that line is quite obviously a rising trend, 4.7% year on year.
I just fail to see how this is sustainable. There was a rush to complete transactions before the stamp duty rules change.
Yeah.
And I suspect that in the coming months, those deals would have been arranged before the rise in gilt yields. So I suspect activity will fall back over the coming months.
I mean, just as an aside, stamp duty is now so vast and so egregious. It is a real distorting effect on the property market. And
Yeah,
it's
I completely agree. It's another tax on young people, Richard.
exactly,
It's just totally immoral.
The UK, so the Citigroup Economic Surprise Index, not very many surprises. Is that good? I think, is it? No, that's bad. It's down -50. So some negative surprises there.
Yeah, that's bad. It's like UK bad.
Indeed, job posting index continuing its downward trend.
Yeah, the latest data is only for the 20th of December. So presumably, over the holiday period, they've just kind of haven't had much data.
Yeah, UK wage growth is at falling very slowly, 6.5%, but it is a very slow fall.
It is. Yeah.
It is a
It's
fall at all, really.
Well, it's in order for this is what's worrying the bond markets. It just looks like UK inflation is sticky, and that's because we've mandated, in part, it's because we've mandated, huge rises in the minimum wage.
A sharp dip in business confidence reported by the British Chamber of Commerce in both manufacturing and services following the budget, and KPMG reporting an accelerating decline in permanent placements in December.
Yeah, and frankly, when you look at what's happening in the markets and the fall in sterling and the rising gilt yield, and all the commentary about how the world is investors are losing confidence in Britain, that is not going to boost confidence either.
So this chart shows that forecasts for government finances have tended to be over-optimistic. The actual outturn in blue, and the sort of shaded lines are forecasts which are mostly in excess of actual, even if you discount what the forecasts were in COVID, which means that effectively the government is running on a big dose of over-optimism.
Yeah. And I think a lot of the reason we are where we are is that during COVID, Rishi Sunak spent money like it was going out of fashion. And actually, there are consequences to that.
Completely. So in the FT today, was it? Sorry, something I read this morning. The government debt, UK government debt, has risen from 800 billion in 2010, I think it was 2010, 2012, to 2.2 trillion now.
God.
That's just an extraordinary. And during that period of time, of course, the interest bill dropped. So our moronic politicians made hay in spending
Yes.
wildly profitably, um, and someone else is having to pay. Well,
Yeah. Well, us.
us, and it's such a mess. And it was all the Conservatives. It was basically the Conservatives,
Yes.
the party of fiscal rectitude. UK is a high tax, high spend economy. Isn't that a depressing graph?
Yeah. It's shocking. What's shocking is the fact that, you know, government services in the UK now are really very poor.
Yeah.
Um, but spending has not come down post-COVID.
We spend
What
all
is
this money, but we seem to spend it very poorly indeed.
Yeah.
So the suspicion is that the Chancellor has no headroom. She's got no margin for error. If she comes back to raise taxes, it'll be even more damaging to the economy, which means she's going to have to do some form of reining in public spending, which I think would
Yes.
be very sensible, but is anathema to the Labour government.
Well, the reassuring thing is she has reiterated that the debt rule is non-negotiable. And so the OBR is going to be coming up with new forecasts. She's going to have to rein in public spending. And so the UK will cut its deficit to a sustainable level, in contrast to a lot of other countries. Now, there will be consequences of that in that she's raised taxes for private business and it's raised public spending to offset that. But now public spending is going to be constrained. All that means that the UK economy is likely to slow even further than it's slowed already. So we will be stuck in stagflation, although I continue to predict that a slowing economy means inflation will come right down.
The Sunday Times yesterday, they were talking about the understanding by the Labour government of the private sector, and it basically said that none of their MPs, and this may not be entirely true, there may be one or two, have any proper experience of working in the private sector. They're all public sector, NGO, political apparatchiks.
I
And
know.
so they have single most important part of the economy, they have no experience of whatsoever.
I was discussing this on the board of a small startup that we are looking to hire a third member of staff. And that is actually on it because of the third member of staff. Getting it right is absolutely crucial. And the chairman was saying, well, we can put him on 3 months probation. And I was saying, I'm not sure we can actually, because you
Yeah.
now have labor rights from day one. And so the problem is that people represent themselves on the CV, and you really have not much way of checking what they're actually like. And that probation period is crucial. And getting rid of it, I think, of all the damaging things they've done to the labor market, that is number one.
Yeah. No, it's just a depth of ignorance, a real depth of ignorance, and a lack of understanding of how to run a business, what the challenges are in running a business, a small business, and what the consequences are of their foolish policy decisions.
Yeah. Well, it's the fact that Angela Rayner then wrote a letter to the FT saying that how the changes to labor rules were good for business. I mean, it's just a fantasy.
And I blame the Tories for their gross incompetence over the
Yeah.
13 years, whatever it was, 12 or 13 years.
Yeah, true.
I'm not going to name David Cameron.
Understood, Richard.
So, I mean, this is just as that she has to either reduce public spending or raise income taxes.
Yeah. Now, if we go back to the previous chart, this COVID spike in spending, that needs to be unwound. They need to cut the size of the government.
Because they've never come back from that, have they?
No, it was declining and then it's shot up. Who are those people, extra people? If you know where all that extra money's going, some of it will be on debt servicing because they've messed it up. But why has the size of the government increased so much post COVID and not come down? If you know, please get in touch.
UK long-term gilt yields, highest in 25 years.
And frankly, this chart is out of date because it was mid last week. It's now at 5.4. The Bank of England gained independent control of monetary policy on the 1st of May 1997. So it's the highest since 98, the era of inflation targeting.
So the UK has got a significant premium on its debt to both Italy and Spain, which feels unfair, but maybe we just need to take a step back and a long, hard look in the mirror.
Yeah, absolutely. We have a fiat currency. Basically, the market's saying they don't trust us.
And we have enormous amounts of QE. Thank you, Mark Carney, who appears probably won't be elected as the next Canadian Prime Minister. I would say that's a narrow escape for the Canadians. So UK summary, who else? Little data since Christmas. It's looking pretty weak across the board. We've still got inflation, gilt yields rising. The people are nervous that the UK economy can service government debt, and it's not looking good.
And actually, while we're on the UK, quiz of the week. Okay, so this is the A465 from Swansea to Monmouthshire in Wales. Okay, it was free of roadworks this week after the conversion to expanding it to a dual carriageway in both directions. How long did that take?
Well, clearly, I suspect it wasn't quick.
No.
The nature of the question. 15 years?
Close. 23. It cost 1.3 billion. They planted 285,000 trees, moved bats, dormice, and greater nested newts, etc., etc. Just, to get anything done in this country takes forever. Wrapped in bureaucracy.
Refer back to the previous question of what is this money being spent on, Keith?
Yeah. Yeah. And onto the EU. So we had preliminary CPI numbers for the EU, and that wasn't good. Inflation up 0.4% in December, well above expectations. And that meant year on year, inflation was actually on consensus at 2.4%, up from November. Service inflation, sadly, was sticky at 4%. Most of the increase in inflation was due to energy prices, though. Core flat at 2.7%, just not coming down towards target. If we look at the components of EU inflation, you'll see the problem is services. Expectations were a decline towards, what's that, 0.15%, and it came in at 0.25% month on month, too high, basically not coming down fast enough. The good news was food inflation was very low and goods inflation was very low. The unemployment rate continues at all-time lows since the inauguration of the Eurozone. Retail sales were weak in November and year on year only 1.2%. Consumer confidence is declining again. Economic sentiment is declining again. Industrial sentiment's been poor for a very long time now and is declining further. Presumably we're because fears that Donald Trump will raise tariffs. Services sentiment actually pretty stable, though not at a good level. You see that pre-COVID, you are averaging, what's that, 10? It's now 5 or 6. Consumer inflation expectations, this is very bad, rising again. The construction PMI stuck in the dead zone, frankly. Loans to companies, we have a section coming up on the causes of the UK's economic underperformance since the GFC. And spoiler alert, it could well be related to banks. Now, the EU has the same problem of being heavily dependent on bank loans for capital. And what you're seeing is loan growth very poor. Loans to household picking up, but still a very poor number. M3 actually growing at 3.8%, not terrible. Economic surprise index, poor. Job postings actually flattening off pre-Christmas. Wage growth coming down, and that will be good for EU inflation. France, similar pattern. French wage growth, that is very compatible with the 2% target. Now, if you look at labour productivity, it has been terrible post-COVID. Relative to trend, actually negative. The Eurozone has become less productive, and that presumably is related to energy prices and the decline of European industry. And when we look at Germany, which is the heart of the Eurozone, Germany looks structurally weak and expectations are for it to keep falling. That will mean at some stage EU inflation comes right down and the ECB cuts to below R star, i.e. to stimulative. And German unemployment's picking up. But unlike the UK, France and Italy, their budget deficits are out of control. They're running at over 6%, i.e. double the EU deficit limit, and with no prospect of them coming under control. The new French government, last year the French government had 4 prime ministers. The new one, Francois Bayrou, is proposing a budget that cuts the deficit to only 5.5%. Still terrible. Let's see if he gets that through. Okay, so summary, EU inflation picked up to 2.4%, primarily driven by energy prices, but services inflation remains sticky. It was at 4% in December, up from 3.9% in November. Bottom line, the EU economy looks structurally weak. We're expecting inflation to come back down towards target because of that structural weakness in due course, and the ECB to start cutting rates harder because the economy really is struggling. And there's the prospect of tariffs on EU imports when Donald Trump comes in less than 2 weeks' time. Richard, the US.
Thank you, Keith. So non-farm payrolls was an unexpectedly positive number, significantly better than expectations for December. We do know, however, that non-farm payroll data is constantly being retrospectively revised substantially, and that it has all sorts of statistical tweaks made to it. So what this is in terms of reflecting the real level of underlying employment, I think, is unclear. Education, health care and services are the ones that are creating the job. The jobs, 80% of the jobs, education, healthcare, retail, leisure, and hospitality, the next biggest ones. Government still creating lots of jobs at 33%. Of course, all of that, if Doge comes into being, a lot of those jobs that have been created will start to disappear.
So these are numbers in thousands, Richard, by the way. But the other thing about government is a lot of those jobs are in local government, not in the federal government.
Yeah. The construction sector also added jobs.
Yeah, I mean, this has been absolutely amazing. The continual rise in construction sector jobs, given very high interest rates, which should curtail investment.
And full-time employment is down from its peak, but it rose a bit in December, seasonally, presumably. But the US jobs market is not looking weak.
I think that's the summary. That's all we need to know.
Yeah. And the household survey reported strong jobs growth in December versus a weak November. In the labour market, it's showing some signs of bottoming there with the jobs added in thousands and moving averages thereof.
Yeah, and I think the Indeed job postings, which we've been covering for a while, also have been showing, flatlining.
Yeah.
Job openings not falling anymore.
US hourly earnings month on month, 0.3% on expectations. Year on year, 3.9%, very slightly below expectations. Continuing that sort of downtrend and consistent with their Fed's 2% inflation target if there's 2% productivity growth, which is easily achievable.
Yeah, in the US. No, the US is amazing compared to Europe.
US weekly hours worked, 34.3, which is the same as November. And the participation rate sort of leveled out at around about 62.5%. Unemployment rate, about 4.1%. The U6 unemployment rate, a little bit better than expectations at 7.5%. Job openings, still in that downtrend, but fairly positive to November.
Yeah, the jolts, the U6 unemployment rate seems to have turned. That is no longer rising.
Yeah.
Now, 1 month is noisy, but actually, when you look back over the past 4 months, it has stopped rising. So, has the deterioration in the labour market come to an end?
The jobs quits is continuing its downtrend, so it's just continuing to be less secure in their jobs.
Precisely.
And labour flows are weak and not actually particularly consistent with the non-farm payrolls data.
Yes, exactly. Because this is the JOLTS hiring rate and job finding rate, and they're poor and falling. So, how's that? There's a lot of contradictory data, but what matters for the markets is people believe the non-farm payrolls, and also the household survey shows a similar pattern. So you'd have to believe those over this.
Okay, so ADP employment change is up 122,000, but pretty unremarkable, really.
Yeah, and again, the ADP proves to be an unreliable guide to non-farm payrolls. ADP undershoots, then non-farm payroll beats.
US challenger job cuts continuing a downtrend.
Yeah, no sign of a rise in layoffs.
ISM manufacturing PMIs be stable, 49 or so.
Yeah,
Services PMI again quite stable, early mid 50s, 54 in December.
yeah, pretty good.
High employment hit a new cycle low.
Yeah.
Yes.
So again, some contradictory data here because manufacturers, to be fair, the non-farm payrolls did show declining manufacturing employment, and that is what you're seeing here.
Factory orders month on month, pretty flat really for the last few months. Durable goods orders likewise pretty flat for the last few months.
Which you would expect. If monetary policy works, you'd expect that.
Yeah. And total consumer spending is beginning to rise again, having sort of bottomed in early 2023.
So, I mean, that suggests that the US consumer is absolutely fine. The US economy is absolutely fine.
Yeah. Chicago PMI is actually not looking very healthy. Pending home sales is looking okay, 2.2% up in November. Pending home sales year on year is up 6.9% in November.
Yeah. So defying higher rates.
Yeah.
And the 30-year mortgage rates in the US are now 7% again. So, and we've got a chart of housing affordability later. It's just absolutely abysmal. I don't know how the US housing market works.
So the US house prices index month on month falling a bit since the summer, continuing to fall. Year on year up 4.2%, but that line is definitely pointing down now. That trend line is pointing down. Michigan consumer sentiment is rising nicely. Michigan current conditions is looking okay-ish, isn't it, Keith? I mean, it's not like it was pre-COVID. Maybe
Yeah.
to reset.
I mean, either you have to believe that people have become systematically more miserable post-COVID,
I
or
can
you have to
wonder
think
whether
this is
that's what
wrong. So do you think that's true, Richard, or not?
I wouldn't be surprised if that's what has happened, Keith.
Yeah.
Michigan consumer expectations continuing to rise gently, although down the last month. 1-year inflation expectations still on that downtrend.
Yeah. Not good, though. Big spike. I mean, it has had this before.
Yeah. 5-year inflation expectation sort of on a fairly gentle uptrend now, spiking up to 3.3%.
Yeah, not good. Not good. The Fed needs to get these under control.
US initial jobless claims falling.
Yeah.
Continuing jobless claims pretty stable. Jobs posting index has definitely flattened out now. And indeed, wage growth is picking up very slightly, 3.3%.
But 3.3%, I mean, that's below the Fed's reported wage inflation of 3.9%. And this is absolutely compatible with inflation of 2%.
Yeah. And LinkUp is continuing to report rapidly declining job openings in the US, which is contradictory to the bouncing jolts, so contradictory data.
Yeah, odd.
US Dallas Fed weekly economic GDP estimate, 2% this week, 2.7% last week. And Atlanta Fed GDP now for Q4, 2.7%. And New York Fed GDP nowcast, 2.3%. So sort of in that range, in that mid 2% range. St. Louis Fed is a bit of an outlier at 1.9%. Citigroup Economics Price Index pretty much neutral at the moment. Trueflation is at 3%.
Yeah.
So the stock market is increasingly supporting the US economy in terms of the current value of family stock market investments. And a huge spike over the last 12 months. So they've gone up from $150,000 to $250,000, which would be a 70% increase, I believe. And 2024 showed massive US immigration that is inevitably going to slow with Donald Trump becoming president.
Yeah, but this is the extent of this is really extraordinary.
Yeah.
Because I thought that they're getting it under control. Actually, to be fair, hang on, that's 2023 is the huge spike, but all that is very good for the US economy, frankly, in pure GDP terms.
Population estimates in terms of the age. Is this the age
No,
distribution?
just total population, mate.
Population, right. So total population estimates for various countries shows that actually all of the United States is estimated to continue to grow through to 2100. I just have to comment on this. I think there's a lot of misunderstanding about population estimates and a failure to see it in the round. So the main reason why we're causing such ecological damage to our planet is that the human population is too high.
Yes.
And the human population needs to drop for sustainability. There's absolutely, in my mind, there's no question of that. And so economists, rather than saying, oh, woe is this, they should be saying, how does the smaller economy function? We need to make the economies, the populations, allow the populations to fall naturally. How do we make the economies stable during that process? And the whole thing there is completely out of the current approach is this is a disaster. We're going to have a demographic disaster. It's entirely the wrong approach.
Well, the thing is, any discussion of population control is completely anathema in this country, because it gets, how are you going to incentivize or disincentivize people to have children? Currently, we don't have that issue because we've got a replacement ratio of 1.44.
The issue is in the countries with rapidly growing populations, and that's because they don't use birth control.
Yeah.
And so that's that. But my general point here is that rather than saying economists saying this is a disaster, we should be saying this is something that has to happen for the safety and security of the planet. How do we manage it?
In the case of Japan, where they've had declining population for a while now, yes, GDP is not going anywhere, but when you look at GDP per capita, it's absolutely fine, and they have a very good standard of living. And so, it's a question of what you want.
Yeah.
And I think most Japanese people would say that they have a very crime-free society. Food is very cheap, and they have a good standard of living. Why would they want 3 flat-screen TVs or whatever to create more GDP growth?
I agree. So, in summary, non-farm payrolls was undoubtedly positive. There's a little bit of contradictory information elsewhere, but not a huge amount. Services PMI is positive. Inflation expectations are rising, but it doesn't look like inflation is moving out of control. So we've got a strong US economy, and Donald Trump is coming in, and we shall see what happens thereafter.
Okay, thank you, Richard. On to China. So we had inflation numbers in China in December. They were 0, in line with forecasts. Look at the last few months. China is struggling to create inflation. So year on year, inflation is 0.1%. What wouldn't we give for that? The manufacturing PMI was 50.1, below expectations. The services PMI actually ticked up a bit. Latest reading indicated that the stimulus measures by the government and the central bank were beginning to yield results. Watch this space. That meant the general PMI was rising. So those 3 figures, so those 3 charts are all the National Bureau of Statistics, the official numbers. The Caixin private sector manufacturing PMI fell. Services rose, so actually in line with the NBS numbers, and that meant the composite was just above 51. So Chinese economy expanding weekly. Balance of trade out today, very strong, better than expectations, and frankly on an upward drift I seriously wonder whether that is US importers trying to get their orders in before the tariffs come in. Exports, therefore, were very strong, 10.7%, well above expectations. Imports also beat. And Chinese bond yields continue to tumble, well below those of Japan now, and the bond market is saying the Chinese economy is structurally weak. And those falling Chinese bond yields come despite Chinese debt as a percentage of GDP being much higher. And we're talking total debt here, private sector and public sector, being much higher than in the US or the Eurozone. And we talked earlier about Chinese population beginning to decline. And then last episode, we were talking about whether those numbers can be relied on at all. But the working age population is already shrinking. And to me, the chart of Chinese bond yields shows once again that in an aging society does not create inflation. Actually, the decline in investment demand leads to deflation. And this chart shows global car production and just how dominant China is now. You see the UK is 1.1% of the whole. China looks to dominate, like it will dominate EV production. So Chinese economy looks structurally weak to me. I mean, there are slight pickup in the PMIs, etc. But when you look at bond yields, the bond market is telling you that the Chinese government is struggling to create inflation, i.e. excess demand. And onto one chart. Now this is a breakdown of the exchange in US corporate profit margins over the period 2000 to 2019. Later on, we'll show you a chart of profit margins which have been rising, but everyone has been attributing that rise in profit margins to higher productivity, globalization, etc. Actually, it's mainly due to the fall in interest rates and the fall in tax rates, particularly under Donald Trump. Now, going forward, those are unlikely to be repeated. So if you look at the components that were not due to finance, the biggest one was wage savings due to globalization, i.e. outsourcing jobs to China and therefore reducing competition for jobs, globalization of the supply chain, and the red bar is productivity, domestic productivity. And so if you become more dependent just on those three, the margin expansion is going to come to a halt. And actually, we know that interest rates have risen, and it's going to be very difficult for Donald Trump to cut taxes any further. And that suggests to me that margins are going to come under pressure in the US.
So looking at the global bond sell-off, so we have government bond yields, as we know, rising strongly pretty much everywhere. Charts showing all of the increases, although the absolute levels, like German Bund, is only at 2.5%, isn't it?
Yeah, but the thing is, Richard, when we think about the the rise in UK bond yields to levels of 1998, we'll talk about this later. But back then, the ratio of house prices to incomes was about 3.5.
Yeah.
It's now 8.2. So houses are unaffordable for young people at these levels. So asset prices have risen enormously. And I just don't see how that is sustainable given these prices. And also, we know that the UK government debt has increased enormously over that period. And that means that if it's to balance the books, and let's hope it commits to that, and all the indications are that it is, that means that they're going to have to reduce spending and raise taxes to pay the interest bill. And also, because the Bank of England did enormous amounts of QE, the rises in bond yields mean that its losses on its bond portfolio have shot up. And unlike the US, the UK actually deals with those losses via the budget with real tax transfers. So, just to pay for the losses, we're also going to have to raise taxes.
So the yield curve this is the Treasury 210 yield curve is steepening, suggesting that the market is anticipating higher interest rates in the future. In other words, we ain't done yet on the on US debt yields.
Yeah, or it suggests that actually the 2 year bond yields are sustainable and it's charging a term premium, which is true. But what it's saying is it's no longer expecting US interest rates come down.
Yeah. And so markets are only expecting one Fed rate cut in 2025, as opposed to two that they were expecting in late 2024. And US inflation expectations remain subdued.
Yeah, they've
So,
risen a tiny bit.
yeah, I mean, I guess, I mean, the issue with asset prices, to my mind, has been brought about. I think we have to exclude the US from this discussion because the US is the world's reserve currency and it's a different model. But in the UK, one of the asset prices have risen, in roughly speaking, in accordance with the government debt. Government debt has risen massively over the last 15 years, as have asset prices. Government debt can't rise anymore. And in fact, government debt actually needs to fall.
Actually, I disagree with that, Richard. And I think actually when you look at Japan, what government debt absolutely can rise as long as
Right.
inflation is under control. And I think what's happening is the bond market is essentially saying to Britain in particular, you can't borrow at these levels with this level of inflation. If you want to borrow at these levels, then inflation has to be much lower. When you look at Japan, what's been absolutely remarkable over the period is just how much it's managed to borrow, but then its inflation is zero. Growth is poor, so bonds were a good bet because bonds are entirely risk-free, government bonds.
That's a good point, Keith. So US inflation expectations here have risen about 0.35% since their September lows.
Yeah,
but they're
which
still
is substantial, actually.
Yeah, but it's still only 2.4%.
Yeah.
The components of the yield are interest rate expectations and term premium, and the term premium has risen to the highest since 2015, and the inflation year break even is the highest since 2024, which is not particularly remarkable, as is the yield. So basically, the term premium has risen very substantially, isn't it, Keith?
It is. Yeah. Now, what I think that is I think that's uncertainty. I think that's uncertainty about Donald Trump. What's he going to do? Is he going to explode the deficit, et cetera, et cetera? Basically, the outlook for interest rates, et cetera, has increased, and therefore markets are charging more to buy US government bonds.
Yeah. So here we have excess core PCE inflation. So you can see that the main factors are housing and various idiosyncratic factors such as auto insurance inflation, which is one of those things that fluctuates. So
there's not much evidence of resurgence in US inflation, frankly. And we've seen wage growth. Wage growth is perfectly compatible with the 2% target. So market inflation expectations seem to be market is getting in a tiz, but there's not much evidence over it yet.
There's a jump in ISM services prices paid this month, which suggests that inflationary pressures in the US may be returning.
Yes.
And it's
Yeah.
at that high level that it has last got to, excluding the inflationary jump, it last got to in around 2018.
Mm.
So
Yeah, not good.
the
Actually.
jury is still out, I think, on whether inflation is actually resolved.
Mm. Yeah.
So UK gilts particularly badly affected, and they've risen to levels last hit 27 years ago. Interesting about the Liz Truss crisis is that with Liz Truss, the gilt rate jumped massively over what was the current Bank of England base rate, whereas the jump we've had here over the Bank of England base rate is not so great.
Yeah, but at the same time, the 30-year is so the Bank of England base rate is 4.75% currently, and the 30-year yield is 5.4%. So that is an absolutely extraordinary, like 70 basis point premium on base rate. So the market is charging 70 basis points a year, enormous number, and locking in higher interest rates for the next 30 years. And the Bank of England thinks that interest rates at 4.75% are restrictive, and then the bond market's locking in even more restrictive monetary policy for 30 years.
Yeah.
I just don't think that's sustainable, frankly. So
what are the reasons the long-term premium has leapt so much? So we've got political risk rising, Donald Trump uncertainty, and definitely concerns over the US government debt sustainability, with US forecasting a 6.5% fiscal deficit. And there are some concerns over the resurgence of inflation, although at the moment it seems quite muted.
yeah,
These comments apply equally to the US, Europe, and
yeah,
UK. But borrowing costs generally being driven up in these economies over what they have been. In the US, the 30-year mortgage rate's back above 7%. I think our 5-year fixed rate mortgage is probably going to be back above 5% shortly, if it's not there already. Obviously, they particularly adversely affect budget deficits with the increase in interest spend. And it's completely outside the control of the short-term control of the Chancellor. And in the UK, we've got QE losses on the Bank of England's holdings of government debt. And that is, of course, a whole separate issue, as what were the Bank of England doing in doing so much QE in any event and reducing interest rates to such an extent in any event, and then sitting by whilst the government borrowed so much money in any event. I'm sorry, but I do hold the central banks to be highly irresponsible and not fulfilling the function that they should fulfill. Anyway, so the bottom line of all of this is that we have a real mess on our hands.
Yes, absolutely.
To put it in non-technical terms. This is the house price to income ratio in the UK, showing it's 8.2 times in 2024. Back in the late 1990s, it was 3.5 to 4 times, which is why so many people have been priced out of the property market.
So essentially, the cost of a mortgage has doubled if interest rates are the same as they were back in 1997.
And UK households are facing a 1.27% mortgage refinancing hit, with 700,000 homeowners coming up to remortgage their fixed rates, and they will be mortgaging at a much higher rate than the current fix.
So monetary policy works with a long and variable lag, and it's still tightening. Everyone with a 5-year basically who rolls off in 2025 is going to face substantially higher mortgage payments.
Yeah.
While we're talking about the UK, thank you to Magnus, who sent me a lecture from the Institute of Economic Affairs about the causes of the underperformance of the UK economy. Okay, so when we look at the UK economy pre-GFC, just like the US, it was growing at a steady rate, actually at about 2.2% per annum, similar to the US. It is post-GFC, and we have talked about this many times before, that the UK has just ceased growing, actually, since the pandemic, and it's barely bigger than it was after the GFC. So, in contrast, the US there's a drop after GFC, but then it's resumed trend. And the difference between the two is big and steadily growing. So something happened in the UK economy during the Great Financial Crisis. Now, the lecturer, Tyler Goodspeed, put the blame on the banking system. And the chart here shows real credit to the non-financial sector. And the blue line is the UK, and the grey line is the US. And you'll see that after a dip in the US, credit starts to grow again. In the UK, it's not grown at all. It's actually fallen since the GFC. And he puts the blame on overregulation of the banking system. So his thesis is that post GFC, there was an increase in regulation on large banks, and the UK banking sector is concentrated in a few large banks, unlike the US, which has many thousands of small banks, and they are then subject to capital ratios, etc., constraints on the size of their balance sheet. The UK also put in a bank levy, i.e. a tax on the size of the bank balance sheet. And as he says, when you tax something, you tend to get less of it. So banks have been conscious about the size of their balance sheet and have been concentrating on return on capital. Banks have also been forced to hold high quality liquid assets to cover 30 days needs, which essentially is financial repression. It means they need to hold government bonds. And as he puts it, in essence, the banks have been forced to lend to the government by buying government bonds rather than to the private sector. There's also just been a general increase in regulation. So those increased costs and regulations on large banks in the UK have reduced bank lending to small businesses and businesses in general. Now, I have a friend, Michael B. Thank you very much for your contribution, who used to work for a big high street bank. And his point was that post GFC, the high street banks concentrated on return of capital, given regulators' own focus on capital. And when they looked at their business mix, they saw that credit card lending is very profitable, wholesale lending decently profitable, lending to small businesses has only a third of the return on capital of credit card lending. And therefore, if you're capital constrained, it is the last area that you assign capital to. You let credit card lending grow as large as it wants to be, and then anything left over you assign to the less profitable areas. So small business lending had only a third of the net interest margin of credit card lending. And his point was small businesses can't pay the 20% interest margins that citizens pay on their credit cards because they have to look to their own profitability. In order to pay 20%, they have to be able to use that capital generating 20% margins on it. Difficult. So bottom line is in a banking industry that's now capital constrained, small businesses are structurally starved of capitalism. capital. As he says, it is difficult to have capitalism without capital. So what's the solution? Well, the solution is to reduce the overregulation of the banking system. But the UK has signed up to Basel III. So that will require either it to leave that framework or an international agreement to reduce the overregulation of the banking system. His other points were you need to reduce planning constrictions, particularly on the green belt. We know you just can't build anything in this country, but the effect of the green belt is that you can't build on the areas most closest to the most productive centers of the economy. And finally, energy cost matters. More on that later. But when you think about what causes global recessions, often a key catalyst is higher energy prices, particularly in the form of oil. And the UK has been systematically increasing its electricity prices. So we now have the highest electricity prices in the world. And we're not expecting that to have any effect on the economy. Of course it does. And on UK electricity prices, Richard.
Thank you, Keith. Well, what a depressing picture, eh?
Yeah.
What a depressing picture. I mean, I
So
think.
what do you think? Do you agree with his analysis?
So first of all, I would say that from my own relatively limited experience of non-property based small companies, bank debt is impossible. You can't get bank debt. You have no security. They will require personal guarantees. People don't want to give personal guarantees because they're risking enough anyway without risking everything, their family home, etc. They're all risking that. So they're for small businesses without property security. I think it's very, very difficult to get back bank lending. So I completely agree with that. I mean, electricity prices, obviously we're coming on to that, but clearly that is a gross failing by our politicians to have any sort of coherent energy policy and any understanding. And I lambast the Labour government for not understanding the economy, but actually a lot of that is also true of the last 13 years of Conservative government. So I think he's absolutely spot on, and that we have dug ourselves into a very deep hole.
Well, the thing is, Richard, it's a very pessimistic analysis, frankly, because unless you change, the UK's adherence to Basel III, there's no solution. Unless we develop a much larger venture capital, etc., industry like the US has.
So UK electricity prices and their effect on industry. UK industrial electricity prices are 114% higher than the EU median for medium consumers, and for large consumers, even worse, 150% higher than median. Unfortunately, we've got Ed Miliband as the Energy Secretary.
Yeah, he thinks they're going to come down, so we'll be fine.
And the premium UK electricity users pay versus the European competitors has been steadily increasing. And see that purple line, and it's since 2020. I mean, it's always for a long time it's been higher, which is bad, but since 2020, 2021, it's absolutely rocketed up, hasn't it? And it didn't come back down basically after the Russian invasion of Ukraine. So the irony of all this is we have masses of gas, North Sea gas.
Yeah, I know, but it's more environmentally friendly, Richard, to import it, to compress it in America, ship it across the sea, warm it up, uncompress it. That is more environmentally friendly, according to Mr. Miliband. And all the jobs are obviously over there rather than here.
I need to go away and sort of rethink my philosophy of life then, don't I? So I can come back and agree with Mr. Miliband. So the good news is not really good. I mean, it is good news. It's fallen since the post-COVID highs, but it puts UK businesses at a huge competitive disadvantage to their international rivals.
Yes, that is the point.
So the culprit is not gas prices, which aren't far off the UK median, but it is that electricity price is much more expensive relative to gas. And the UK there is a huge outlier on electricity prices. So this is showing that UK domestic gas prices are actually well below the EU median, but our domestic electricity prices are high. Not as high as Germany, but we know what Germany have done wrong.
Yeah.
But much too high. And 20% in 2024, 20% of our electricity bills were green subsidies. So all of those beautiful windmills destroying the view from our coastlines have been paid for out of green subsidies.
Yes, absolutely.
And 11% of UK electricity generation is used by industry. And the comment here is that that's likely to reduce because UK industry is uncompetitive and it's pricing itself out. Obviously, if UK energy prices fall, particularly for industrial users, then that would change. So there is a British Injury Supercharger scheme, which I hadn't heard of before, launched in April 2024 to support sectors particularly exposed to high costs of electricity, steel, metals, chemicals, cement, glass, paper. Expected around 24 to 31 pounds per megawatt hour when the full package comes into effect in April 2025.
Yeah, the thing is, by quoting it per megawatt hour, Richard, it makes it sound more generous than it is.
So, in fact, whilst it is a subsidy, as Keith says, it still will leave the UK as by far the most expensive electricity and roughly twice the median EU cost.
Yeah.
I mean, basically, we just need to be generating more of the stuff, don't we?
Well, we've got a structural problem in that, we now need to maintain two separate energy systems, renewables, and then when the wind doesn't blow, we need to maintain a whole load of gas-fired power stations.
I mean, we need a few large nuclear power stations.
We do.
We need them to be built quickly. So we're closing down our last remaining blast furnaces and replacing them with electric arc furnaces, which is obviously good for the environment, in theory, as long as your electricity is generated without producing carbon dioxide. But electricity is so expensive in the UK, it's hard to see how they could possibly have any form of competitiveness in electric arc furnaces.
Yeah, that's it, basically. We've got the most expensive electricity in the world. We're now converting to electric arc furnaces.
Yeah. So UK marginal producer and therefore price setter is gas 98% of the time. So basically gas is a price setter. We are, as that chart table shows there, between 30 and 50% more expensive than 50 and 100% more expensive than France and Germany.
Yeah.
Grid connection charges are enormously higher in the UK as well, like massively higher.
Yes, this is a big problem.
But presumably this is an area that ripe for taxation, isn't it? So Rachel Reeves can raise more money.
Yes.
I mean, why have we got this so badly wrong, Keith?
Because we don't have mature, intelligent political debates in this country. They depend on virtue signaling of who's going to be the greenest. Nobody's allowed to talk about money.
And this has happened for many, many years.
Yeah.
And it's just incompetence. Is that like any debate that gets shut down is a danger to the wealth and health of the economy. People think that by shutting down a debate, it's a good thing, but actually it's a really bad thing to do because you don't get balanced discussion.
So this text at the bottom here is pretty shocking. In May 2023, National Grid expected transmission costs for a transmission connected site to be around 4.26 million per annum. By 28-29, it expects that to be 6.59 million, a 55% increase. So they're expecting this to get much worse, the cost of connecting to the grid. So these are the additional policy costs, like the green energy measures for comparing France, Germany, and the UK. Now, it looks like the UK is actually better, and that is because UK steel producers only pay £5 a megawatt hour. You pay £89 a megawatt hour.
So, according to UK Steel, all of this is adding up to the UK paying almost 50% more for its electricity than in France. And this is a big, for these businesses, these industries, this is a big cost.
Yeah.
So this fundamentally makes them uncompetitive. UK steel production was 5.6 million tons in 2023, which is well outside the top 20 global steel manufacturers. With Spain, even Spain, little old Spain, producing twice as much.
Yeah.
And yet, advanced engineering, advanced steels, supposed to be one of the UK's strengths.
Yeah.
So UK steelmaking is in decline in much because it cannot possibly be price competitive given the
Yeah.
energy costs. Oh, and this week we almost suffered blackouts. I didn't know that with the cold weather.
Yeah.
There was no wind. What do you mean there was no wind, Keith? Government policy stipulates that there must be wind.
Well, we need to get Ed Miliband to stand in front of a wind turbine and just talk.
No, you're conflating hot air and wind. They're different.
Yes, good point.
So it speaks for itself, doesn't it?
Yeah. Gas-fired, Rye House gas-fired plant was paid an eye-watering £5,000 a megawatt hour to turn on and generate electricity and fill the gap. And so this is what happened during the day. And this is the capacity forecast. And so what happened was the Viking link interconnector to Denmark was offline. And because there were no renewables coming in, the forecast capacity turned negative. And that would have meant rolling blackouts in parts of the country. So load shedding, as it's called. But they actually managed to sneak through. So a day ahead, they were forecasting blackouts with, what's that, 2 hours to spare. They got Viking back online and blackouts were avoided.
I mean, it's a disgrace, isn't it? We consider ourselves to be a first world country. And we've done this to our economy, to our manufacturers, to our energy grid. It's modern societies function off electricity, off energy.
But Richard, you can boast of having the greenest energy system in the world. That's, you go to international conferences and boast about how well we've done. That's the upside. And actually, while we're talking about the UK energy system, this week, the UK committed to invest in liquid air energy storage. So the fundamental problem is that when renewables generate power, they can generate too much power, and then which creates energy prices can then go negative. And then obviously when the wind doesn't blow, you need energy. So you need to be able to store electricity generated by renewable sources. To get to net zero by 2030, the government is forecasting an absolutely enormous increase in batteries and long duration energy storage. Now, what's that? Well, part of that is liquid air storage. So what you do is you use your very cheap excess renewable energy to freeze air to, what's that, minus 100 degrees C, whatever, and at which point it becomes liquid. You can then store it, and when you need electricity, you warm the air up and use it to drive a turbine to generate electricity. Now, this is most efficient when you have cheap cold or waste cold, i.e. from LNG regasification, And then at the discharge phase, you have waste heat, i.e. from a nearby gas-fired power station or coal-fired power station. Now, its promoters claim it has a 70% round-trip efficiency, which I've really struggled to believe. This seems a very energy intensive and inefficient process to me. And notice that is with excess heat for the warming up of the air. So you're using free heat from another source. So
That's why it's so efficient, Keith, because presumably he's not calculating the cost of the free heat.
yes, that's true. So the UK National Wealth Fund has invested in a new 300 megawatt hour, 50 megawatt liquefied air storage plant near Manchester, aims to produce its first electricity in 2026. The anticipated cost of the power is £500 per kilowatt hour. So, reminder, domestic electricity price is around 25p a kilowatt hour, so 20 times higher than that. And lithium-ion battery is estimated at £300, gas 75, or including the carbon tax 90. Bottom line is we're investing in this nonsense and your electricity bills will keep on rising.
And our industrial heart will keep on declining.
Yeah. So this is the intended investment plans for the UK energy sector. And pause, have a look if you're interested. You're going to see massive investments in onshore wind, solar, all of that, and batteries, all of that, very expensive.
I'm mindful, actually. I think there's a strategy here that Ed Miliband was the shadow business secretary. So he spent several years working out how to screw businesses. Now he's working out how to screw the energy sector, and he's going to combine the two to create complete economic collapse. It's cunning, isn't it?
Well, let's see what happens next. Meanwhile, in France, Richard is talking about nuclear. In December, the Flamanville pressurized water nuclear reactor commenced power generation after a 12-year delay. Now, a 1.6 gigawatts is the most powerful nuclear reactor in France, and its first new one in 25 years. But the bad news is it came in 4 times estimate and obviously 12 years late. The good news is what the French are doing is what we used to do, learning by doing. And so they've now created a simplified design, and Macron has ordered another 6 with an option for 8 more. If you're going to have a nuclear industry, you need to invest in it. And yes, there will be cost overruns, but you learn.
And you also, we need to invest in the future, and the UK has to invest for sustainable, cheap electricity in the future. We have to do nuclear power. There is no alternative to that. There's no sensible alternative to it. And this government just needs to get on. I mean, the Tory government should have done it. It's just we have to do it.
Yes. So, and reminder, all this nonsense. Yes, we do need to reduce our emissions, but whatever we do is just trivial compared to what's happening in China and India.
Yeah.
And quickly onto global food prices. So we like to do this once every so often. This is the UN Food Price Index, and it ticked down slightly in December, having risen sharply in Q4. What's going on around the world? Well, the cereals, actually, cereal prices having spiked strongly during the pandemic and then the Russian invasion of Ukraine, they are right back down. And there's no concerns over cereal demand. Sorry, cereal supply. In the case of dairy prices are rising again. That's not a happy trend. The meat price index, that looks okay, actually. Oil prices, though, not good. And again, this looks like climate change. So vegetable oil prices have been rising on concerns over flooding and excess rains in Southeast Asia. The sugar price index, that looks okay. So bottom line, food prices will be increasingly volatile in the future due to global warming. Vegetable oil and dairy prices are rising again. Vegetable oil prices, as we've shown you, are rising really quite sharply. But the majority of the index and the majority of consumption is cereals, and cereal prices have not systematically risen post-COVID. They're back down to their pre-COVID levels. So I prepared some extra sections on US housing and the sustainability of the Japanese debt, but I think we've kind of done enough this week. We'll save them till next time.
Okay.
So inflation, Richard.
Thank you, Keith. So not much new data since our last broadcast. EU inflation CPI 2.4% in December, which was up, and core CPI 2.7%, which is flat. Bank of England next meeting is the 6th of February, ECB is 30th of January, and the FOMC is 28th, 29th of January.
Yeah, and I think in every case we're expecting them to hold rates.
Yeah. Japan seems to have created a 2% inflation level, and miraculously it seems to have managed to stabilize it at that level for the last 12 months.
Yeah. So hence my concern about Japanese debt sustainability.
Yeah.
Watch this space. We'll cover that next time.
And this is suggesting that US health insurance price index has plummeted over since 2022. And the question, having followed a fairly sort of consistent upward trend. So is US health costs likely to increase dramatically over the next few years, adding a chunk to US inflation?
Well, the question really is, are the US government stats reliable? Does anyone really think that, US health insurance costs are back at 2018 levels?
That is a good point, Keith.
Yeah, it's just like, and so actually the orange line here is average family health insurance premiums, and the blue line is US inflation, and that is the price index.
But Keith, there's a one-off adjustment factor in there.
Yeah, I've forgotten about hedonic adjustments, obviously, Richard.
Yes.
Good point.
Yeah, it's keyhole surgery.
US inflation, US and UK inflation numbers come out next week. Let's see what happens. And on to recession watch, which is very short. So the higher proportion of US consumers are living paycheck to paycheck. This has been a K-shaped recovery. So the red bars are consumers where spending on necessity takes up over 90% of their income. And you see it's been growing. It's heading towards 30% of the population. And when you look at spending by households, well, the wealthy are the only ones, well, the proportion of overall consumer spending spent by the wealthy has been growing, and for everyone else it's flat or down. You'll see the working classes, the middle classes have been doing worse. And this is odd. Credit card debt plunged in December. That's odd. So consumers did not turn to their credit cards. We know that credit card interest rates are the highest they've ever been. So perhaps they are pulling in their horns, but I don't see how that's compatible with decent retail sales figures. And reminder, there is a crisis in US offices. The vacancy rate keeps on climbing. And the apartment vacancy rate is also rising. And that should be good for rental prices, and that should help bring down inflation. We turn to Europe. Well, this is European flights, and actually they are below their pre-COVID average. So European economy, further evidence, not doing very well. In summary, Yeah, the US economy is doing just fine, but there are a few oddities. In particular, um, the working classes are not doing well. And the fear is that rising interest rates, etc., you're moving up the income curve for people who are struggling financially. On to other charts.
The froth is coming out of the luxury goods market. There's been quite a lot of talk about this, hasn't there, recently? So this is showing a 30% decline in Rolex Rolex market
Mhm.
index, and you can see kind of from 2020 to 2022, this index doubled pretty much,
Yeah.
and now it's down by 30%. What should its and actually since 2017, it's tripled. So what is the real value of this? Look, what is the correct value of this index? Don't know.
Yeah. I mean, I just don't understand these people's obsession with things like, secondhand Rolexes. You saw that Eric Morecambe's glasses sold at auction for 30 grand. And I was thinking, what are you going to do with that? I mean, it's just, people are obsessed with clutter, is
Yeah,
the word I'd use.
yeah, I agree. The diamond price index is I mean, the problem with diamonds is that one, De Beers operate a cartel, so they try and manage supply very carefully, don't they? Exactly. The
Mm.
industrial diamonds can be made much more easily now than previously. So it's supply and
Yeah.
demand of this is very strange, I think. And fine wine index has fallen substantially, uh,
Yeah.
22% in the past 2 years.
Yeah. That's good news for me.
Young people drink around a quarter of the amount of red wine that we do, as in us oldies,
Yeah.
and so average consumption is dropping.
Yeah. So actually, the French wine industry, when you go back to, this wine prices, the wine industry faces a fundamental problem actually, in that,
Yeah,
when you look at how much the French used to drink, they're now drinking like almost 90% less. My children hardly drink at all, despite my encouragement. It's just systematically people are being much more sensible. You know,
you're such a good father, Keith. That's the
well,
thing.
I did put some red wine in their bottles when they were, feeding, in the hope of getting them into, the family culture. But clearly, it hasn't worked.
I, I'm sure you did, but you haven't given up, have you?
Um, my son says he gets a hangover from drinking literally anything, so I've kind of given up with him. My daughter will have a glass of wine with me over dinner, and I
Yeah.
appreciate that. But she won't have, half a bottle.
The service jobs no longer required, according to Statista. Um, this is in the US that cashiers down
Yeah.
340,000 between projected between 2021 and 2023. We all know our self checkouts. Secretaries and admin assistants substantially down. So a lot of these simple jobs are going to be removed from the economy. And I
Yeah.
suspect these numbers are too low, substantially too low, I suspect.
Well, so one thing I wanted to talk about next episode is autonomous vehicles,
Yeah.
because the growth in Waymo is now spreading to increasing number of US cities, and it's getting more and more acceptance. And I can see that if this takes over in the US and then around the rest of the world, you're going to have an awful lot of taxi drivers
Yeah.
who lose their jobs. And frankly, I don't see why they're starting off with cars and taxis, in that I would have thought the biggest benefit of autonomous vehicles is long haul truck driving, where, the truck driver doesn't need, if you have an autonomous truck driving along the motorway, it can drive 24 hours a day or between petrol stations, as opposed to, the driver having to take a break every few hours and only being able to drive 8 hours a day. So I forecast a lot of hauliers and taxi drivers losing their jobs in the coming decade.
Completely. And I think it's very hard to predict which areas are going to fall to AI first, but I think a lot of them, there's going to be a lot of disruption in the employment market over the next 10 years because of this.
Yeah.
So, political crisis in South Korea has not upset its bond market. Look at that.
Yeah, amazing. I'm absolutely astonished by this. The president's holed up, resisting attempts to arrest him.
Yep.
And, no, people are perfectly happy to buy Korean debt. It's going through a terrible political crisis.
And young adults rapidly losing faith in our democracy. I mean, this is very sad. I have to say, I would classify myself as rapidly losing faith in our democracy. I'm not losing faith in democracy. I'm losing faith in the competence of our system.
Yeah.
That's different.
Well, the thing is, Richard, I'm not at all surprised by this because the bottom line is the UK economy, the modern economy is just not working for young people. And sadly, I can see this just getting much worse because as we have an aging population, that aging population increasingly votes for policies that benefit old people. And so I've noticed that even talking about the costs of healthcare, etc., and euthanasia or anything is just absolutely beyond the pale. You're not about to even talk about that, and so this problem is only going to get worse.
It's another subject that's taboo because basically politicians make subjects taboo because they're on the too difficult pile. So to avoid having to address them, they make them taboo. And if you wish to discuss them, then by definition you are a bad person. Therefore, there's no need to discuss it with you. And all that happens is you don't have a proper debate on how society should be governed.
Yeah.
And the modern economy is failing the young, and it's dreadful.
I've thought this was really, the trend is really amazing. I mean, have never married, 30-year-olds who've never married, sorry, who have ever married. So in 1983, by the age of 30, 80% of US adults had got married. It's now down below 50. That's an enormous drop. Okay, you need some good news after that, and here is some good news. So, in 1963, there were only 417 nesting pairs of bald eagles, the national symbol of the US. But now there are over 11,000, and the species is no longer considered endangered. So conservation measures do work. If we care about these things, we can fix them. And onto equity. So we have two tables this week. This is for the year 2024. And the only table that matters is the right-hand column. That is performance over the course of the year. And you can see generally a very strong year, led by the US S&P 500 up 23.3%. NASDAQ up almost 30%. And that meant the all-world index was up 15.4%. The all-share did okay, up 5.6%. Stocks Europe up 5.4%. The Hang Seng and the topics were both strong. Bitcoin had an amazing year. Now, this is year to date, i.e. first 2 weeks of the year, and more mixed picture. The Hang Seng is down 5%. US markets have had a bad couple of weeks. Well, on the back, particularly after non-farm payrolls. We'll take you through the charts. This is the all-world index. You'll see actually it peaked mid-December, so we didn't have the Santa rally. The all shares now being flat to downish since May last year. Euro stocks, same picture. S&P 500. Actually, again, no Santa rally coming off. Are higher bond yields finally affecting the equity market? This is the Nasdaq. Russell 2000 actually not looking very good. Trump so far, we've had the Trump bounce, now it's completely unwound because bond markets are unsettled by his fiscal plans. Hang saying, well, that pop in October on Chinese stimulus measures and measures to support the stock market, that's fading. Topics not going anywhere. Bitcoin had a great year last year, but now stable. Sterling, we are in trouble. I hope you got your holiday money already. Sterling, before Rachel Reeves' budget, pretty much 1.3. It's now 1.22. Euro also not doing great because the dollar going through the roof. Strong economic growth, high interest rates, rising currency. Invest in the US. This is VIX, has picked up again, and on recent stock market volatility. Some charts, Richard.
Thank you, Keith. So this is the S&P 500 annual chart. So it had an excellent year, up 25%, including dividend. So the CBO is estimating that the US economy is growing faster than capacity, and margins are higher as a result, which clearly becomes unsustainable at some point.
Yeah.
And the PE ratio of the S&P 500 is at levels that haven't been seen very often, dot-com bubble, COVID bubble, and have not been sustained. So
yeah.
Something we've been talking about for a long time. Tech has been responsible for all the earnings growth of the S&P 500 since 2022. Interesting. And it is expecting tech profit margins to keep growing.
Yeah.
In the case, but at some point it won't be.
If you look at the rest of the market, though, the green line, nada.
Yeah, and actually, if you go back to that chart you showed earlier, Keith, with the profit margin, a lot of the profit margin expansion being due to taxation and interest.
Oh, yes. Yeah.
Then one would expect, certainly on the interest front, those margins to start dropping. S&P earnings growth in the market is expecting earnings growth around 12% in Q4. So we shall see.
Yeah, but the point is that it's now expecting 12% essentially in Q4. It was expecting 14.5%. So expectations have been coming down, but that hasn't stopped the equity market just marching higher.
Yeah. And this market is expecting 21% earnings growth in 2025 for the Mag 7 and 15% for the rest of the market. And the S&P has actually outperformed earnings over the past couple of years. So we shall see. And during 2024, 7.1 trillion was added to market cap. Most of it tech. And looking at that chart, most of that was, NVIDIA. 10 stocks account for 60% of the S&P's 500 gains. This is all stuff we would know is very concentrated in those tech stocks. And it's still very concentrated. And JP Morgan think that retail investors made about 10% last year, as opposed to that 25% on the S&P. So they should have bought an ETF. Yeah,
well, that's right.
And equities massively outperformed analysts' forecasts in 2024.
Yeah, amazing. So what you notice is the real returns are much more volatile.
Yeah.
Forecasts are always in a range, and then.
Yeah. Interesting. And it's the first time that the US stock market cap has achieved 2 times GDP. Yeah, this is a euphoriometer. So the S&P on the log scale and euphoriometer on the right is the red scale. So euphoria is pretty high at the moment.
Yeah. All-time highs. Pretty much.
Yeah. And the best performing last year was Palantir, which rose 370% on a PE of 402 at the end of the year. Palantir.
Yeah. And do you remember during .com, the Sun Microsystems CEO saying, how the company was valued was it 10 times sales?
Yes.
And it was that was a ludicrous valuation. Well,
it is 73.
This is 73, PA ratio of 403.
Yeah.
Just absurd.
Yeah. Okay, so this is a graph of the South Sea bubble.
Yeah. Yeah, basically, bubbles burst. was struck by looking at that chart of Rolex prices.
Yeah.
Go up, 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 longer than you can possibly imagine, and then they come down.
Yeah.
And frankly, I expect the same thing to happen to Palantir and Nvidia. In fact, on the case of Nvidia, clearly I've been absolutely wrong, and everyone who's ignored everything I've said the last 18 months has done very well. But in the case of Nvidia, you know that lots of people are developing these chips,
Yeah.
and at some stage, the demand will start to flatten off because you're investing enormously in the initial capacity. And then you can see that as demand starts to flatten off and the competitors catch up, Nvidia could see both a slowdown in growth and a massive fall in margins. So, yeah, it will keep on going until it doesn't, and then it'll come right back down.
Yeah. So stocks are very expensive in comparison to bonds.
Yeah, absolutely. So, I mean, this is my point that essentially an equity can be thought of as a very long dated um, index linked security,
Yeah.
and yields have risen, therefore price should fall. Okay, thank you, Richard. On to commodities and quick summary. Well, energy, oil started the year very strongly on the back of UK and US sanctions on Russian oil producers. European natural gas prices softened. That's good news, but they're still very high. Industrial metals had a good start to the year, as did precious metals. So look at energy commodities. So this is last year. So the only column you're really interested in is the far right. Over the course of last year, oil prices were flat to downish. Sadly, natural gas prices shot up, and coal had a poor year, uranium had a poor year. So the start of this year, the last 2 weeks, oil prices have risen sharply. Brent up 7%, WTI up 6.8. Natural gas prices are coming back down as the cold snap in Europe eases. Natural gas prices in the US, though, have risen sharply as they've had a cold snap. Coal has had a terrible start to the year. So this is Brent bouncing right back up. Reminder that OPEC is threatening to increase production by 2.2 million barrels a day at some stage this year. Let's see whether they actually do it. WTI also had a good few weeks, up 6.8% on the year. Numbers specific to the oil market, well, this is for last year, and you'll see overall US inventories grew by 25.8 million, although some of that was used to refill the SPR. So US crude production ended the year up 270,000 barrels a day. US still growing production. Also next week, I will be attempting to cover the latest Goering and Rosenweig study, which claims that US shale production is close to peak. Well, they've been saying that for a while now. Last year, production still grew. And that was achieved despite a falling Baker Hughes rig count down 18. So this year, we've started the year with a build in the US, and oil prices have ignored that and climbed. Oil production is pretty flat. Baker Hughes rig count continues to fall. And reminder, the IEA is forecasting the oil market will be in surplus throughout 2025. How much of that is already in the price? But certainly, oil prices have been rising over the last couple of weeks. And this is consumption. You'll see oil consumption in aggregate did grow slightly in 2024, but per capita consumption peaked way back in 2015. So if we get more of an energy electric vehicle transition, etc., more efficient use of oil, then it's going to be difficult for oil consumption to keep rising. In the third world, developing world, traffic congestion is so bad that it's questionable whether having a car is actually provides much marginal utility.
Mm.
Looking at EU natural gas prices, big rise over the year and recent peak due to the cold snap, but down from that. But that is not good for domestic heating bills. The problem is that because we have reduced our gas flows via pipeline from Russia, we are dependent on LNG and storage. And so during winter, we use up more and more of our storage. And so the drawdown in storage levels is higher than compared to previous years. And that means that that all needs to be refilled in the summer. Um, Systematically, gas prices look like they'll be structurally higher. And the EU does not seem to understand the balance of power in the energy world. So it has threatened Qatar with enforcing a new law of enforced labour and environmental damage, which would allow the EU to fine Qatar up to 5% of its worldwide revenues if it was found to be breaching that law. And Qatar provides 12 to 14% of the EU's LNG capacity, and the energy minister, Saad Al-Kaabi, has responded by saying if the EU attempts to fine it 5% of its worldwide revenues, it will simply stop providing energy to Europe. The
It's bonkers,
boot,
isn't it?
it's bonkers. They do not understand how the energy markets work or how economics work. They are dependent on Qatar. Thank you to Simon W. for sending that through, by the way. There's UK, very similar to Europe. US, keeping on rising, actually, after very low gas prices for a long time. Rising LNG exports will close the gap in gas prices with Europe, but also had a cold snap in the US. Coal prices looks terrible. But global coal production is yet to peak. It hit a new all-time high in 2023. Uranium, not great. Now, the problem is for the uranium price that price action is in enriched uranium. And despite the sanctions on Russia, the US actually imported 27% of its enriched uranium from Russia in 2023. Good news for the world is that Japan has a sensible energy policy and has been restarting its nuclear power stations. On to industrial metals, Richard.
Thank you, Keith. So we're just looking at the year to date. So aluminium was up 6.7% in 2024. Cobalt was down 17%. Copper pretty much unchanged, really. Iron ore down a big 27%. Lithium down further 22%, having had a bad 2023. Neodymium down 11%. Nickel down 7%. Tin was actually up 13% and zinc up 11%. So a bit of a mixed bag there.
Yeah, big for industrial metals. That's in 2024, and now year to date.
So year to date, in other words, in the last couple of weeks, the only couple of significant movers, copper is up 8%. It's quite a big move. Iron ore down 5%. Likewise, quite a big move for a short period of time. Nickel and tin both moved 2.5% up, and zinc down nearly 4%. I would say the one of interest there is copper up 8%.
Yes, absolutely.
So there we have the aluminium chart. Cobalt, copper.
Yeah, it's a good start to the year.
Yeah. Chromium
is dead, I'm afraid. The last data source we use, last chromium price is now mid-November, and it's basically stopped working. So we will stop reporting chromium, I'm afraid.
Iron ore, lithium,
Going nowhere.
neodymium, nickel.
Yeah. Now, the spike in nickel prices in May last year and June last year was mystifying. We know there's a wall of nickel coming out of Indonesia in the next couple of years, and it's resumed its downward path.
Tin, I think. And precious metals, we have, so last year, gold was up 28%, silver was up 19%, and platinum down 8%, rhodium up 3%, and palladium down 26%. So gold and silver doing well, PGM's not doing nearly so well. And this year so far, gold is up 2.4%, silver's up 5%, platinum up 9%, rhodium 2%, and palladium nearly 7%. So actually, they're all doing well so far this year. So then we have gold, which has sort of leveled off for the last few months. Central banks continuing to be big buyers of gold. Silver, which has been flat really for about 7 or 8 months now. And rising industrial demand. There's a forecast deficit in the silver supply over the next few years, which is expected to impact on prices. Platinum, rhodium.
Yeah, going nowhere really.
Yeah, and palladium likewise.
Okay, and on to rates, and it's been absolutely shocking and catastrophic, really, for the UK and for me. So the yield curve, bear in mind that current base rate is 4.75%, and the UK 30-year yield is now approaching 5.5. So you're getting, the market is charging a pretty much a 75 basis point premium over base rates for lending to the 30-year and for the UK for 30 years. And if you look at where we are in the 2-year and 5-year, you're talking about 4.6%. So the market is now expecting interest rates in the UK to average around 4.5% over the next 5 years, i.e., the UK, the Bank of England would only be able to cut once. I think that's just totally wrong. The US, this is much more normal looking yield curve, frankly. So what they're saying is that US interest rates will fall to a low of about 4.25%. So only one more cut, really, and then stabilize. Again, yeah, at some stage, you know that the economy is going to recession and there will be strong interest rates cuts. But right now, US economy is looking fine, and we are now in third great bear market. At some stage, I expect this pattern you've seen previously to revert, but you don't know how high this will go, is the bottom line. And the 30-year gilt yield has risen to levels last seen 27 years ago. The Bank of England gained independence in May 1997. So you see that rates then fell rapidly as the Bank of England gained credibility and control over inflation. And now the Bank of England has lost credibility. You'll see this big gap between base rates and the 30-year. Astonishing. Basically, the Bank of England needs to regain credibility. Or the other way of looking at this is the bond market is just charging a huge premium to lend to the UK government given its fiscal position. And this has just been a very unusual cycle. Normally when the US starts cutting rates, long bond yields, so the 10-year, comes down. This time it's shot up by 1% since the first Fed cut. Amazing. But we are still on a rate cutting cycle, although the bond markets do not seem to be appreciating that. And global rates are way above their pre-pandemic average. And I think what this is saying is that bond market, there is a consequence to all that fiscal irresponsibility we saw during the pandemic.
Absolutely.
So the debt to GDP ratios have risen, and they haven't. The trouble is that governments have not got their fiscal expenditure back under control. And now, what's going to happen in the UK is the bond markets are going to force the UK government to be responsible. So the UK should bring its deficit back into balance, either by cutting spending or raising taxes. This chart was from before non-farm payrolls, but it shows that actually the rise in bond yields has not been caused by an improving US economy. And you saw the Citigroup Economic Surprise Index is pretty much neutral, not positive. And this is the yield premium for gilts over the US Treasuries. You see that it's gone from charging actually a substantial premium to the US to charging a substantial premium to lend to the UK. The UK is not doing well. So this is the UK 2-year, which is a key driver of UK mortgage rates. And you'll see that has risen by 1%, best part of, since August. That is very significant monetary tightening and will cause pain for lots of UK mortgage holders. This is the 10-year, absolutely shocking chart. It is shot up by over 1% since September. This is the 30-year, exactly the same, except maybe even worse. And those are extreme numbers, 5.4%. US 10-year, similar pattern, actually even worse, up over 1 point, almost approaching 1.2%. Massive rise in yields. German Bund, the Germans actually have their fiscal deficit under control and they're fiscally responsible. Look at that. Shocking. France, all this puts pressure on government deficits and has consequences for the wider economy. Italy, Greece. So concluding comments. Well, the global bond sell-off has accelerated at the start of 2025. Will that affect the global economy and equity markets? It should. But I think a lot of that sell-off has been driven by uncertainty over what Donald Trump will do. He started erratically, threatening, asking to buy Greenland and then not ruling out the use of force to seize it. Will he instigate tariffs? Next time we see you, we will know a bit because he will have been inaugurated. Richard, how are you doing?
Well, I'm okay, Keith. As you know, sort of my precious metals and uranium commodities really haven't moved terribly much over the last few weeks. So I'm just sort of sitting on my hands doing not very much.
Very good, Richard.
How about you?
Well, I'm absolutely shockingly bad. You'll all know that I've had a total disaster, and that the rise in bond yields means that I am having an absolutely enormous drawdown, down over 30%, which very painful. And people on Discord saying, "Do I have any risk control?" No, I don't, honestly. And you see the consequences of that. Then that I've suffered absolutely enormous losses. But my strategy is frankly to take that pain because I play the cycle, and my strategy, which has been an absolute catastrophe this time, has been that as things go against me, I add risk to the position, waiting for the cycle to turn. Now, in this case, the cycle hasn't turned. But my long bond position in TG61, which is absolutely enormous and has cost me now a huge amount of money, I'm now getting 7%. The equivalent is so it's yielding 5%, which means for 40% taxpayers getting 7% equivalent. I don't see a problem with inflation. In fact, I think that inflation will come down really quite quickly now because the fiscal deficit will have to be brought under control. The private sector is also slowing. So that should tend to bring inflation down. And I was listening to a report by the Institute of Economic Affairs, who were talking about the shadow MPC. And the shadow MPC produce their own forecast for inflation and for where interest rates in the UK should be. And they were saying the shadow MPC concentrates much more on monetary aggregates, and they looked at during the pandemic the massive increase in the money supply and were forecasting that with a long and variable lag of about 18 months that there would be a big spike in inflation. And the Bank of England obviously didn't believe that, didn't raise interest rates, was way too slow. But since then, monetary aggregates have actually been shrinking, and they've been forecasting that actually inflation will come down with a long and variable lag of around 18 months, which they're talking about mid-year. So I think that it's reflexive now. So yes, I have lost mark to market absolutely enormous amounts of money. And, it's a very good illustration of not what to do. The number one rule for any private investor is try not to lose money. And I've lost absolutely vast amounts. If I try and think about the absolute numbers are really frightening. But the worst thing you can possibly do in this situation is panic and get out. My strategy is just to live through the pain. And actually, you know what? I was in the pub last week and meeting some friends. And we didn't talk about it at all. I'm quite happy to talk about it anytime, but it just wasn't the most important thing going on. Some of my friends have real problems. I've just got a huge amount of egg on my face, embarrassment, and mark to market losses. The reality is, at 7%, I can live on this indefinitely, and frankly, I will. So, in the case of taking these losses, I'm not going to. The strategy is to just suffer the pain and wait until the good times, and there will be good times. But in the meantime, it's going to be incredibly volatile, and I will be back on here every week confessing my sins and obsessing about the bond market. So, watch this space. I know you're all doing much better. Congratulations, particularly for not listening at all to me. And may we all have a better 2025. So we'll be back in a few weeks' time. Thank you very much for watching. Please can press like and subscribe to the channel. And it's goodbye from Richard Wheater.
And it's goodbye from Keith Jordan.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.